Good afternoon. This is Eric Anderson of SEDCOR, and I hope you're all doing well. Thank you for joining us today. We know many of our communities are facing extremely difficult challenges right now, and one thing I want to be sure that we're letting you know is that the SEDCOR team is working with our partners to help in any way we can. And at this time, as well as in the coming months and maybe even years of recovery efforts. So our thoughts are with the folks that are dealing with this firsthand, and hoping that the situation continues to improve. Once again, thank you for joining us today for our economic update. What does the next chapter of our state's economy look like? That's a million-dollar question that is, I think, increasingly difficult to answer. We keep throwing things at economists that make it a lot more difficult every week, it seems. But we're looking forward to hearing what our panel has to say today, and we appreciate their engagement during some very busy times. And also a big thank you to the University of Oregon for sponsoring this event, and more to come on that. But first, a little bit about our speakers. We're happy to have Mark McMullen, the state economist at the Oregon Office of Economic Analysis, here with us. Mark serves as the state economist and director of the Oregon Office of Economic Analysis. That office provides objective forecasts of the state's economy, tax revenue, and population to advance the goals of the governor, the legislature, state agencies, and the public at large. Prior to joining OEA in the fall of 2010, he served as the director consulting at Moody's Analytics and was a researcher with the Congressional Budget Office. Mark was an undergraduate at Pomona College and did his graduate work at the University of Pennsylvania. But first, I'll be introducing, or we'll be handing it over to Tim, a very familiar face, Tim Duy of the University of Oregon. We're always thankful to have Tim's engagement and involvement with us, and always look forward to not just these events, but actually getting together with him, playing and doing the brainstorming. He's a great partner for SEDCOR. Tim is an economics professor of practice at the University of Oregon. He received his BA in economics in 1991 from the University of Puget Sound, and his master's and PhD in economics from the University of Oregon. Following graduate school, Tim worked in Washington, D.C. for the United States Department of Treasury as an economist in the International Affairs Division, and later with the G7 Group, a political and economic consultancy for clients in the financial industry. In the latter position, he was responsible for monitoring the activities of the Federal Reserve and currency markets. Tim returned to the University of Oregon in 2002, and he is the senior director of the Oregon Economic Forum and the author of the University of Oregon Statewide Economic Indicators, Regional of Economic and Business, and is currently a member of the Oregon Governor's Council of Economic Advisors and the State Debt Policy Advisory Commission. So once again, we're thrilled to have Tim and Mark here. And first, I'll introduce Tim. As you can see on here, we do have a Q&A function. Hopefully everybody's getting to know Zoom like we are getting to know Zoom, which is, we're getting better, but still have our challenges. But there is a Q&A function at the bottom of your screen. If you do have a question, and we'll be sure that the panel tries to address it during this event. Also, for your information, this will be recorded both on Facebook, and the Zoom presentation will be on the SEDCOR website sometime later today. So before any more, I will hand it over to Tim. Thank you, Tim, for being here.
All right, well, thank you very much. I think I am now on camera. I'm going to just give a couple brief comments. Thank you very much, Eric and Jenny, for helping put this together, and thank you, SEDCOR, for being a really good partner on these events and other ones we've done in the past. I'm sure all of us are looking forward to be able to do in-person events next year, hopefully. Optimistically, and getting back to something closer to our normal lives. And also thank the University of Oregon for continuing to basically keep me employed to do these kinds of events and work with the community on economic issues. So with that said, I'm going to find share my presentation here, and we're just going to take off on what's going on with the economy. So I've titled this After the Fall, Will the Recovery Continue? Because we're thinking of this year in three separate portions. One was the initial shutdown we all experienced earlier this year in March and April in particular and into May. The second part was the rebound as those shutdowns ended and we started to resume our normal types of activity. And now we're going through the recovery stage. And what our big question is right now is how strong is that recovery stage going to be? How quickly are we going to return to peak levels of activity and employment? And sort of what's holding back the economy and what's driving the economy forward. That's what we want to think about as we get through the next half hour of my part and then another section on Mark's part. So I guess let's start off with the obvious, and that's that gross domestic product here was clearly down quite a bit during this the second quarter of this year. Basically, if you shut everything down, the data goes bad. I don't think this should be a huge surprise. Output was down more than 30% on an annualized basis in the second quarter. That doesn't mean that the economy was 30% smaller. What it meant was that if we continued that pace of loss through the entire year, the economy would be 30% smaller. Reality is that we didn't continue that decline. We'll be talking about that as we move forward. But the first data was clearly very bleak. So another similar data point was initial unemployment claims, which spiked quite a bit higher in March, basically getting to about 7 million new claims a week. And that's traditional unemployment insurance, doesn't include the pandemic insurance assistance fund for workers not traditionally covered by initial unemployment claims. That's roughly 10 times higher than the worst of the initial claims we saw during the Great Recession. Now I'm kind of mix up Great Recession and Great Depression a little bit. So that's a substantially worse outcome. Initial unemployment claims have been dropping over time and are now around 1 million claims a week. That's still too high, but we're certainly moving in the right direction. I expect that number to continue to fall. Unemployment shot up to a level that we haven't seen since basically the Great Depression this time, well in excess of what we saw during the last recession, but it has obviously started to come back quite strongly or quite quickly back to something that was less than what we saw during the worst of the Great Recession. And I expect that to continue to decline as well. So even though our first data was very bleak, we're already seeing some improvements in the data that we should really be paying close attention to. Now, this has been the same for Oregon overall. Mark's going to talk a little bit more about the Oregon economy, so I'm not going to spend as much time on that right now. When I look at the University of Oregon Index of Economic Indicators, and of course I thank KeyBank for their sponsorship of this work, what we see is a sharp drop in activity in March and April and in May of this year, and then we start to see that rebound. So the rebound is typically consistent with the end of a recession or predicting the end of a recession. So there's a big question I would say about whether we're still technically in a recession now. The economy did grow strongly in the third quarter, and if the economy continues to grow in the fourth quarter, which I expect, then really the recession was a second quarter event. And so that's something where we have to talk about or discuss over the next year is really what constitutes the recession. One other point of this is this measure is designed to be a leading indicator. There weren't any really leading indicators for this recession. It's very different than past recessions. In past cases, we could sort of talk about the data for 6 months, a year, 2 years even, and debate whether a recession is coming and what policy action should be taken to forestall that recession. This was just a recession hit because we turned off the economy. When I look at the Oregon measure of activity, economic activity, also sponsored by KeyBank, what we see is that activity, sharply slowed earlier this year and then has rebounded to something closer to normal in recent months. So this again consistent with this idea that the recession itself was very sharp, but also potentially short-lived as far as the technical recession of a period of time where growth is actually negative. to see sort of how the rebound happened, we can look through a couple indicators. So retail sales, excluding food services, autos, gas, and building materials. These are, this is what we call core retail sales. Food services, essentially, we're going to talk about it a little bit later. Autos are captured in other parts of the GDP data, so we kind of remove them from the sales data. Gas can be volatile, and building materials is also captured somewhere else. But when we look at this core measure of retail sales, what we see is that it dropped dramatically, but then, boom, started to come back up, and is actually above trend right now. And I wouldn't expect it to continue to grow much until we kind of return to its old trend. But that just shows you how quickly some of this spending returned. We're seeing this catch manufacturing activity more broadly too, where you're seeing really good indicators that new orders are up, production is up, the supplier deliveries are down, which you'd expect really if the economy is starting to actually has sped, it went down and sped back up as the supply chains issues started to work themselves out. Employment index, though, is still a little bit low, and we'll be talking about that and whether that's going to improve going forward. Another sign of really how quickly this recovery has been, we can see in motor vehicle assemblies. So there's two stories here. If you see the huge difference between autos and trucks, right? So the move away from sedans and toward SUVs over time. But if you look at what happened in motor vehicle assemblies during the Great Recession, so that's the 2007-2008 period, what you saw was a fairly slow decline as we got deeper and deeper into the recession, and then a fairly slow return to pre-recession levels of activity. So it took till 2015 or so before you really peaked out on auto sales. If you look what happened, auto assemblies, if you look what happening now, auto assemblies just went to zero overnight, more or less, and then rebounded back to previous levels very quickly. So again, you do have to start asking yourself, is this really still a recession? Should that gray bar really be ended a couple months ago? So that's really a good sign. It's also the services sector that's feeling improvement. We see that in this ISM non-manufacturing indexes. Still, though, employment is a little bit weak, and we're going to see whether or not we have some possibilities there going forward. Right? So we know we had this big bounce in the data, and we know that we're sort of in this recovery stage now. And the question is, to what extent are we going to recover quickly or slowly? And this is a chart from Mark's office. Are we going, basically trying to get an idea or visualize what these possible outcomes are. You notice there's no numbers on this, right? There's no length of time to recovery. There's no percent change from the peak. This is a stylized explanation of what could happen. And we're clearly in the initial bounce back stage. You know, our issues have always been tied to, do we get rapid growth because there was nothing really wrong with the economy in February of this year, and thus we can rebound quickly? Or do we have fairly slow growth because we have permanent damage to the economy? And those are the two outcomes or scenarios that we're really thinking about at this point in time. So how are we going to see which of those scenarios? Are we leaning more toward a more rapid recovery or a slower recovery? So good news first. I'd like to start with the good news. Business inventories are very low. Inventories to sales ratios have dropped back to where they were prior to the recession. That's telling us that firms really have a lot of inventory catch up to do, and that's going to create a lot of demand in the system, right? There's still a lot of constraint in these supply chains as firms look to try to basically recover from their, the surge in demand and the drop in production they experienced earlier this year. There's certain sectors that we see that very severely. So lumber prices, for example, have been off the charts recently. And that's because firms expected there to be a collapse in building activity and thus rolled back or shut down or rolled back production at some plants. Inventories dropped very low, and now they're trying to play catch up. So the inventory rebuilding process creates a momentum for the economy going forward that potentially fairly fast momentum for the economy going forward. So that's something I'm watching as we move into the rest of this year. Another big factor is the resilience of housing markets. And so this is existing home sales as reported by on a national level by the National Association of Realtors. Some really important stuff here. You can see that the existing home sales have really recovered. Part of this is pent-up demand from low sales in April and May. We see this nationally, we see this statewide, I see this locally. This is basically everywhere in Oregon where we see a real rush to housing. Housing strength is typically correlated with expansions or at least very weak recessions. So the continuing gains in housing, I think, are an important signal that the economy is going to continue to improve. We're also seeing this in construction activity. So new single family homes sold is above pre-pandemic levels and I'd say pre-pandemic trend. So the issue here is I think people became too pessimistic on housing in this downturn because they didn't understand the strong demographics that are propelling the housing market forward right now. What we have is a millennial generation moving deeper and deeper into their home buying years. And as a result, that's providing a real good backdrop for the housing market. That's probably going to last for 3 or 4 years here and should sustain this market going forward. So that's, again, a real positive move for the market. Builders are feeling that. This is the home builder confidence measure from the National Association of Home Builders, and it is at record highs, higher than we saw during the housing bubble, believe it or not. So home builder confidence super high right now. That should be help propel a housing market forward. New home purchases or just a home purchase generally entails around, studies have shown, $3,700 of additional consumer spending associated with that. So this is a big factor for the market. So that's a good thing. I think it's something we should really be paying attention to as we think about how the economy is going to evolve over the next year. Job openings have been rebounding. So we worry about what's going to happen with people coming off unemployment insurance. Is there going to be a job there for them? I'd say that this is pretty optimistic news, is that there does seem to be quite a high level of job openings in this economy right now. You can compare this to what happened during the last downturn or even the previous one. Job openings fell over an extended period of time, and then only rose slowly over an extended period of time. Now job openings fell. They only fell to 2014, 2015 levels and already back up to 2018 levels. And we remember as we moved into 2018, 2019, job market was really hot. It was hard to find labor. It's not inconceivable that we move into a similar market sooner than expected. So that's something to be watching out for as well. Part of the issue here, and I keep emphasizing this, is there was nothing wrong with the economy back in February. There was no fundamental misalignment, I would say, between some like what we saw in say prior to the last recession. We saw the housing market just go wild and really impact residential investment spending, or in 1999, 2000, we saw the tech market go wild, and we saw that really influence investment activity. There's nothing similar going into this downturn. So there's nothing to necessarily fix, and the lack of things to fix should help us recover on the other side of this. There's another factor here too that I think is important going into next year, and one I certainly would never have expected, say 3 or 4 months ago, and that's how much stronger household balance sheets are. If we look at personal savings, it very much rose out of the park, levels we have never seen before during this downturn. So what happened is that even though people lost their jobs and their salaries went down, the government was basically force feeding us income in the form of tax rebates and better unemployment insurance. That coupled with the inability to spend, particularly early in the downturn, propelled savings higher. And I like to remind people that this is not this is a flow. So this is how much savings there are every month. So you're adding to your stock of wealth by having more, by your saving every month. So what I try to do in this chart is look at personal saving, and this is in billions of dollars, and this is a seasonally adjusted annual rate. So a monthly number here would have to be divided by 12 to see what the actual number was. And then look at the pre-COVID trend. And that difference is what I call excess savings, right? It's savings above what really should have been expected had the economy not entered recession. So typically we see savings rates rise a little bit during recessions. Nothing like this. This is completely out of the ordinary. What that means is that every month there's a huge excess stock of saving that's building. And it's over $1 trillion now. This would say, basically 13 trillion, but again, you have to divide that by 12 because of the weird way we do these numbers. So that's a huge amount of money that's sitting out there that's not been spent. So where there's another thing going on too, is that people use some of their saving, their income, to pay down loans. So credit cards and other revolving lending debt has fallen roughly $100 billion during this downturn. So you have basically a huge increase in savings and a drop in debt. So where's it showing up too? Checkable deposits. You've never seen something like this in the data either. Checkable deposits are up $1.3 trillion or so, roughly from where we started. So that's a lot of loose cash floating around in the background that in theory could come into spending very quickly. And the story I've been telling or worrying about, I don't know if worrying about it's the right thing, but thinking about it as an upside risk, is that if you do get a vaccine sort of toward the end of this year and you start to roll it out to the population in the middle of next year, by the middle of next year, and that looks more likely than maybe we thought last year or earlier this year, then everybody's going to want to go to Hawaii at the same time. That's what's going to happen as all this money comes back, flooding back into the economy, into tourism and travel, I think in particular, because that's the sector that's really been impacted and where there's going to be a lot of pent-up demand. So not only did this happen, but by the way, that stock markets are up and housing prices are up. So household wealth should be quite a bit higher in the third quarter relative to what we saw in the second quarter. So that's all the good news and things that are propelling the economy forward, I would say, into next year. Now, there's still some bad news that we have to worry about. And some of that bad news is permanent job losses are starting to increase. Not like we saw in the Great Recession, but they're moving in that direction. That means some of the temporary furloughs are becoming permanent, as I think we see more permanent closures of business relative to temporary closures. Now, I'm not sure how persistent this permanent damage really is going to be. So for some firms, I think it's just a longer period of downtime than they anticipated. So for example, hotels maybe thought they were coming back this year, when maybe their activity would come back next year. So next year that job will be there. So it's not as permanent as maybe we think. Restaurant activity, I think, again, that's another place where you could pick up activity more quickly next year than maybe people are thinking at this point. But there is that fear of permanent damage to the economy. That entails some transition costs. Those transition costs weigh on our ability to grow going forward. Part of the economy is still impacted for the foreseeable future by the COVID-19 pandemic. So retail sales for food and services and drinking places in particular being held back by sort of our ongoing concerns about being associated with large crowds of people indoors. I think we still have a hard winter to go through ahead of us. Right now we've gotten some relief, although maybe the last couple of weeks not. Our ability to sort of eat outside has compensated for our inability to eat inside. So that's something that we're still watching for, and that's why this sector is probably one to be slower to recover. Obviously, other sectors too. Higher education is also dealing with similar types of issues as we move through this year. So that's a sector of the economy. And I would say overall, travel, tourism, leisure, hospitality, those things are still impacted severely as we go through this next year. Now the good news, for better or for worse, is that set of the economy is actually a smaller set of percentage GDP than I think people often associate it with. Going into this, that was only 4% of the economy. So even if you take off a percentage point or two, that's not really a stumbling block to a broader recovery. And again, I do think these firms come back as we move into the next year. But still, that's a weight that I think we're still dealing with, and firms impacted in those sectors are still dealing with. Another question is about fiscal stimulus. 2 or 3 weeks ago, or 2 or 3 months ago, I was clearly on the side of sustaining this fiscal stimulus is crucial, that the reduction in unemployment benefits is too severe for the economy to basically internalize. Now I'm starting to wonder if that's really the case. That we look into this year is that maybe there's more jobs available than I had anticipated, and there's more excess savings to serve as a cushion than I might have anticipated. So we have this question about how much this fiscal stimulus is going to be sustaining the recovery going forward. So that's still out there, something we should be worried about. Now, if, and I think this is a kind of an interesting story to tell, if both the stimulus was not as important sustaining recovery as we feared, and we still get a stimulus package, that is very bullish for next year. Because basically we'll be spilling even more money into the economy than we would have expected. So that's something to keep in mind as we move into 2021. So, what's my general message here is that the economy has bounced off the bottom. And we're arguably not in a recession anymore. So a recession is not really a recession is not any period of time below your full employment. I would say a recession is any period of time in which the economy is contracting. It's not evident that the economy is contracting. In fact, it's much more evident the economy is expanding, and that expansion is sustainable. So I think this is going to prove to be a very short-lived technical recession, and people haven't entirely internalized that yet. The consensus has been for a slow recovery. I would argue that there's a lot of upside risk to that forecast, and what we're already seeing right now is the recovery is much more rapid than might have been anticipated. We saw this too. The Federal Reserve held a meeting this morning where they maintain low interest rates for the foreseeable future. If you look at their forecasts are much, much improved relative to what they were in June. Unemployment is expected to come in a lot lower than they anticipated, growth higher, inflation higher. Basically across their forecasts, the economy is improving faster than expected. So I do think there's an enormous amount of upside risk to this forecast. People have not completely internalized the importance of the housing market rebounding. People have not completely internalized the amount of potential excess savings that have accumulated and could come into the economy as we move into next year. Just a little bit of confidence, more confidence in the handling of pandemic, confidence in a vaccine, confidence in any type of therapeutic treatment could be really a factor that propels the economy forward next year. Not every sector is going to really gain from or really rebound as quickly. The sectors that are more impacted by COVID-19, that require dense groups of people to be successful, those are going to be impacted for a longer period of time. So conferences, again, arts and entertainment venues, those kinds of things, going to have another tough winter ahead of them. But I would say the economy is trying to grow around that problem and growing around it a little bit more quickly than expected. I do think that people forget that the economy is a fairly dynamic entity, and consequently we see problems, we try to fix those problems. Right? Housing is booming. That's probably not changing. I think that's a sustained trend going forward. You have heard lots of concerns about, say, foreclosures or the possibility of foreclosures going forward. I'm not as worried about that. One is I think that there are jobs that are starting to open up, and I think that you'll see people being able to get those jobs. And also, this isn't like the last downturn where if you kind of got foreclosed on, there was this massive hit to the financial market, to the bank. There's a massive hit to you personally. Now, because housing markets have tended to be strong and remain strong, and there's an underlying demand for the product, you could, in fact, probably sell your house rather than getting foreclosed on and still walk away whole. So the dynamics are not nearly what they were back in 2006, 2007, where we saw the real severe impacts from the foreclosures. So that's something to keep in mind. And again, watch for that spending surge. I think, leisure and hospitality, these things could be pent up. There could be a lot of pent up demand here, and that could really hit that industry hard in a positive way next year. So I'm gonna leave it at that. I want to give Mark time to speak, and I know that of course we want to leave a lot of time for questions. So I'm going to turn it over to Mark now.
Thanks, Tim. That was certainly uplifting for sure. I need the pep talk right now. We're in the final throes. Our prime directive as a state economist is to do the quarterly economic and revenue outlook for the state, and to do this Wednesday. And typically at this point in the cycle, we already have our economic forecast pretty well ironed out and the like. Of course, this time we're scrambling at the 11th hour to try to factor in the wildfires and the like. And so needed the pep talk. I'm going to go and try to hit on some of these macro themes that Tim talked about, but boil them down to the Oregon spin on them. But unfortunately, I didn't bring all the rainbows and unicorns that Tim did, so I'll be a little bit more negative in my outlook. Let me see if I can go ahead and share my screen. Okay, here we go. So yeah, to jump right in, I'm first going to look at some of the excuse me, I got to forward down here, at the job market. What's going on in Oregon's labor market to start? And here we're looking at job losses across different recessions, and you see the red line. The 2020 is a different animal from all of these others over time. The way to read this chart is as we start on the left hand at 0%, that's just as we go into the recession when jobs are at their peak. And then as we progress through the recession, we get some share of job losses as recorded there. In this case, it was 14% overnight. As you know, given the sudden stop that the economy went through, we just flipped a switch and lost jobs overnight. And now you see, about as of yesterday's August employment release, we've gotten roughly half of those, or a little bit less than half of those back already. So this looks not like a recession, but more like a natural disaster, where we have some kind of shutdown and then a lot of rebuilding activity afterwards, where things bounce back very quickly. But that said, this is still a big shock to the economy. And if you look right now, where we're sitting as of August is no better than we were at the worst of the Great Recession in 2007. So there's still, some of those job losses are still temporary, and it'll bounce back in some of the industries that Tim was talking about, the ones that were directly impacted by the social distancing. But nevertheless, in terms of the traditional business cycle, we're just getting started. And Tim's absolutely right that from a technical sense, the overall recession may well be over, provided we don't, stall, going forward. But that said, the real pain of this demand shock has yet to be felt, right? And so underneath these top line numbers, we have kind of a traditional recessionary dynamic. We don't know how big that is yet, because it is yet to play out. But we know the shock was big, and what it usually takes, as you see here, a couple of years before that translates into the full economic pain, right? It takes a while. You know, when we had the Lehman event last time, and Lehman failed and wasn't bailed out, firms in Oregon didn't go out and fire everybody overnight. Of course not, right? What happened is, you know, they just, and you know, and there's still sales in the pipeline at first, but what happens after those events and people become more pessimistic about the future is then, well, the phone rings a little bit less going forward. And so that sales pipeline starts to slow down a little bit and your inventories start to build. And then at that point, maybe you cut back a little bit on the parts you order and cut back a little bit on the labor you hire. And that's when then the recession starts to play out, right? So if you cut back on your parts and labor, then the household that's working for you and your suppliers see a loss in sales, and you get into this negative cycle, which takes a while to fully play out. And so right now we're just kind of stepping into that, although it's being really obscured by what we're seeing at the top line. Whoops, sorry. I'm having trouble here with the forwarding. There we go. So here we're looking at the unemployment rate broken out into two parts to try to get at this, what's going on below the surface in terms of core unemployment. And as you see here, the top line, headline unemployment is coming down quickly. In August, we got down to 7.7, which is even below what we're seeing at the US at 8.5%. And as long as that light blue line continues to go down, that headline unemployment rate, Tim's right, we're not in a recession anymore. But that said, if you start looking at the more permanent or long-term damage of this core unemployment, which unfortunately has some marginally attached workers in the definition as well, but that's starting to creep up, and that likely will continue to go up. And that's, you know, a little bit of a concern because it seems to have a little bit of a broader footprint than the job losses we've had already, which have been predominantly in a lot of the low wage retail and service sectors and the like. That said, the last bullet point on this chart is no longer right. I pulled out some old bullet points as of August. Now, core unemployment is rising about the same rate across the different educational levels of educational attainment. So, but that said, it is becoming more broad-based, and in August we saw job losses in some of our, you know, higher wage industries, healthcare, professional business services, and the like. And so as Tim was telling you, you know, the strongest part of the economy so far has been spending. In terms of retail sales, we're all the way back. Now in Oregon, we don't have access to the same amount of data on spending that some of our folks in other states that have my position do, largely because we don't have a retail sales tax, so we don't get this data. But over time, we've expanded to a lot more consumer-based taxes in Oregon, and we're starting to see those. We have marijuana taxes and you know, hotel taxes and the like now, and of course the new commercial activity tax, but it's going to be a while before we have any real data on that. We have a couple of quarterly payments in already, but we don't have a last year to compare those to, nor do we have any tax returns yet to really talk about the composition of where that comes from. But we do have some specific data in Oregon, and like I said, more and more, and one that we have now is the automobile privilege tax, which is doing great. In terms of the volume of auto sales, we're still a little bit down relative to last year, but in terms of the value, we're even higher than last year as people are buying more valuable vehicles. And so you're seeing that all the way back. One that surprised us on the upside was the video lottery sales. You see here got back to 90% of sales overnight. And that was even when they first opened it up, it was only about 50% of the retailers were allowed to open, given that the Portland metropolitan area was behind in that timeline. But so far so good. It's held up, still a 10% reduction over what we saw pre-pandemic, but a very quick rebound. Less so among the restaurants and bars that are housing the video lottery machines. You see here the reservations for the open table seated diners, only about 50% or so of the total of the pre-pandemic level, 50% or less in Oregon. You see we have the Oregon and the US numbers here have diverged a little bit in the most recent time period, and that might make sense given that we have, you know, the wildfire smoke and the rioting in Portland and the like, that maybe that's starting to weigh on the numbers a little bit. The spike right before is, you can ignore that. Some of that volatility had to do with when Labor Day fell on the calendar for retail sales. You know, the number of the times at holidays and the weekends and how many of those you have in a month and the like are very important to those numbers. And so you get that kind of volatility. But nevertheless, so the consumer has been, like Tim said, has, you know, the American consumer it never ceases to amaze. And for the most part, this has all bounced back very quickly. Going forward, we have a couple of concerns, and I'll talk about those. One, you know, being the amount of federal fiscal aid we had, the other being the income distribution of the hit, and then also pent-up demand. You know, as Tim talked about, there's a lot of pent-up demand potentially still out there to push this spending. As he mentioned, you know, savings rates on aggregate are way up, and that's because of higher income folks and a lot of households that were forced to save, you know, that didn't necessarily lose their job, but lost their ability to spend for a couple of months, and this created quite a bit of savings. And as Tim said, also, of course, the federal aid was part of that as well. And so we have savings and drawing down of debts, and household balance sheets are in great shape. So we should, you know, potentially continue to grow going forward. That can give us some momentum. But there's another part of pent-up demand that's helping right now that's going to go away, and that's really the shutdown timing kind of demand, where during the shutdown, my kid might have needed braces, or I might have needed to remove a tree from my yard but couldn't get a permit from the city or the county to do so. And now that they've opened things back up, that kind of releases this flood of demand. And we've certainly seen that in a lot of our industries, the housing industry in particular. We know some of this surge is all catch up because we kind of interrupted the peak spring, summer sales season. And so some of that is getting, you know, is catch up now. It's just hard to disentangle some of this, you know, temporary pent-up demand that's going to go away versus the more solid household balance sheets, which at least for high income folks should persist going forward. But for now, you know, spending is certainly the most encouraging sign that we have out there in Oregon as well as the US as a whole. So really, part of what's behind this, and part of the reason things have been less drastic than we thought, was just the huge scale of this federal aid has really, really been unprecedented. And trying to get at that here with this picture, looking at total personal income with and without transfer payments. Now, these transfer payments include a lot of things. Of course, the recovery rebate checks and the unemployment insurance is in here, and food stamps is in here, as well as other in-kind things like Medicaid and health services that are publicly provided. And so, as you see here, if we include all this extra federal aid, incomes are actually up 5% relative to the beginning of the year, despite shutdown, despite the pandemic. And so this is something else, obviously. Now, if you were excluding that, we'd be down 5%, which is a significant income shock. And and that's what, you know, we were concerned about going forward. How much is this? What's the size of this actual shock to the underlying economy, and how is that going to play out going forward, despite all of the temporary improvements we're going to see? In terms of the SEDCOR region and all of this federal aid, the region here did participate just about as much as the Oregon average, which is just about at the US average. So not too different from the typical county. But you'll see here, Marion and Polk there are a little bit to the left of the Oregon average in terms of the recovery rebates and unemployment insurance. That largely has to do with the fact that they had somewhat, you know, a little bit fewer job losses here in the SEDCOR region. And so that, you know, kind of makes sense with the unemployment insurance payments. In terms of the PPP loans, businesses in the SEDCOR region got a little bit more than the Oregon average. Not in terms of the number of loans. The number of loans was right about at the average, but in terms of the value, loans were a little bit larger here. And so there's quite a bit of help there. Again, the upside and downside risk, as Tim mentioned, we could come forward with another big federal fiscal policy package that outstrips our expectations, which would be a good thing, or it could, drop off, which is a concern, both in terms of the households going under without the unemployment benefits and the like, and firms, of course, in terms of these PPP loans, which, we're only expected to need to hold up the economy for, a couple, 3 months, and it looks like, longer term support is going to be needed. And so as that goes away, we'll see if that weighs on payrolls going forward. So another big issue in terms of what happened, and why we haven't seen at the top line that much damage, and why we've seen all the improvement on the top line, a lot of it has to do with the fact that these top line numbers are dominated by our high income households. And so, in terms of, or more, I guess more accurately would be, as we've, become more and more unequal in terms of our income distribution, low income households don't always add up to that much in terms of some of these aggregate economic indicators, like Tim was showing the huge overall savings, right? But low income folks, hardly save at all, and so they're not even in that number. And of course, what I care about in my world is the state tax collections, and as an personal income tax state with progressive rates, the higher income folks really move the boat there as well. And so while we're still waiting on some of the good detailed data of folks across different income levels, here we take a shot of the industries, and you'll see that it's pretty clear that the low wage industries took a hit. So what we're doing here is a real simple exercise of saying, okay, let's just put different industries into buckets depending on the average wage in that industry. Now, within each industry, there are some high earners and some low earners, but this is just the average for each industry. And the low wage industries took a bigger hit, which is not surprising given that, they have the leisure and hospitality, personal care, retail, childcare, a lot of this exposure to the tip of the spear in terms of the social distancing type of industries. And so that's clearly an issue on the expenditure side of the budget, but not so much on the revenue side, given that it's just impacting folks that don't add up to as much as the higher income folks do on the aggregates. So taking stock of 2020, the last few comments I'm going to make is just, well, how do we, all this crazy stuff that's going on, how do we really build that into the outlook? And as I said, the one thing we're trying to do at the last minute is to try to build in some of these wildfires into the equation. Now, the issue with the wildfires is very similar to it's very similar to the issue in terms of low wage workers in the sense that our economic data doesn't capture the pain as much as it captures all the rebuilding. And so, what we see in terms of economic indicators during all but the very worst of disasters is typically, it doesn't make them worse or sometimes even better, right? Because we catch a lot of the rebuilding, we don't catch a lot of certainly not the human pain or the environmental damage, or anything like that, but not the wealth either. And so that can become an issue in terms of the wildfires and what it does to the economy and how to articulate that to policymakers. But there is quite a bit of damage here. This one is not in the packet I sent out. I can include it though. I've gotten clearance from Mason, Bruson, and Gerard to do the forest damage. Now, the forest damage, we'll have to figure out. We don't know exactly how much of this land is all burnt, and we'll have to figure out what the pricing is and the like when we, try to take stock of this. But it gives you a sense in the region here of how much private and BLM land and the like was destroyed or is potentially destroyed. That is, this, like I say, comes from a consultant. We also have numbers from the Department of Forestry, which are by fire, not by county, but they're asking us to hold off on releasing those for a while until they have a better chance to vet those numbers. But nevertheless, significant amounts, no matter what price you put on these. But in addition to this, then you have the physical property. And so when we're talking to the local assessors, we're looking at this the Santiam Canyon fire with Marion and Lynn County parts put together, we're looking at about $500 million. So $500 million in these assessed property values, which are probably half the land and half the structures. So and that's split roughly evenly, a little bit more in Lynn than in Marion, but roughly we can say 60-40 or whatever for that $500 million. So we don't really record that wealth loss, that $500 million in lost wealth, or half of that structures. But what we do see is we'll see the rebuilding, which if history is any guide, and insurance rates and the like, we'll probably see 70% to 80% of those buildings rebuilt, which is a big chunk. So we're talking 150, $200 million in the local area in terms of building activity, in addition to what we're seeing now in terms of leisure and hospitality and the like being bumped up, both from folks who are forced to evacuate and from firefighters and the like. Does give us a temporary boost. But what's really more concerning is what's going on long term. And long term, the issue is, what's all this stuff going to do to Oregon's image out there, or its attractiveness to migrants, which is still our primary comparative advantage, is our ability to bring in migrants and young skilled workers and the like. And so that's really what we're looking to in the longer term about, is some of these events of 2020, are they going to kind of tarnish Oregon's image? Now, as you see here from the chart, Oregon's image has been tarnished for some time. George Bush called us Little Beirut, 30 years ago, and that didn't seem to impact migration much following that. But that said, we're getting a lot of bad press now. If you were somewhere in the Midwest watching TV, think of, well, what the heck's going on in Oregon, the worst air quality in the world. You're going to have some guy from Antifa throw a can of soup at you if you come here. We don't even have college football. Shoot, we don't even rake our leaves. And so, at this point, we're getting quite a bit of bad press and whatnot. And so to what extent will this affect migration going forward is still up in the air. So too is the nature of housing, whether or not the pandemic is going to change people's choices in terms of suburbs versus cities, urban, rural, and the like. And so this is still, really the big question going forward. But like I said, I will end on the one positive note that I did bring, although like I said, much more depressing than Tim. The one positive note is that we do have a regional advantage in working from home, which arguably is something that we will see a shift toward going forward. And Oregon, as well as the rest of the Pacific Northwest, does really well on these estimates of both the amount of people working from home now and the potential share of people that can do so going forward. As you see here, Salem is above average in both of those factors. And a lot of that has to do with how nice it is here. Again, it dovetails into the quality of life. In the near term, working from home, when we shut down the economy, it was all about what occupation you're in and whether or not you had the technical ability to do it, right? Whether or not your industry or your occupation lent itself to that. But over the longer term, it's more about quality of life. The people who work from home in communities, it's all about quality of life, and that's why the Pacific Northwest always looks so good. And so from an economic development perspective, this is very encouraging because of what we see on the right-hand side as we look at some of these the industries where we do have a high share of people working from home in the Salem area, art, design, business, finance, computer, math, and the like. These are not only good occupations in terms of they pay well, but they're also occupations you see here from that location quotient that are below 1, which means they're not very heavily represented in the Salem metropolitan area overall. And so this is a potential way to diversify the local economy going forward. So, never let a good pandemic go to waste. Here's your opportunity to grow going forward. So with that, that's it for my prepared remarks, and it looks like we've left some time for questions.
Thank you very much, both Mark and Tim. That was, rarely do we get, discussion of bad news, but also unicorns in the same discussion. So thank you for that. Do have some questions that are lined up. One thing I just wanted to make a comment on is I appreciate, Mark, your attention to the bad press, that we're getting. I know in economic development, at least, that's one of the considerations we've had is, this kind of combining effort or combined reaction to both what's been happening around the national news and how we're viewed, as well as now the fires, and continually hearing that we've got the worst air quality in the world. I think we have to recognize that the state and our partners will be needing a pretty proactive PR campaign, because I think a lot of times we're in a bit of a bubble and don't necessarily see how the rest of the world sees us. And from a business development perspective, that's certainly something that's important to us, how that's viewed. We did have one question about the wildfire impact. Mark, I know you talked about that, but maybe Tim, if you had any thoughts on how the recent wildfires might impact your forecast. I think that actually came in during your presentation.
Yeah, no, I'm sort of aligned with Mark on how we should be thinking about this. It's most likely in the near term. It's like a natural disaster. Things are shut down for a little bit, impacted negatively, but you rebound fairly quickly from that. I think you're really more concerned about some of those longer run impacts that we're going to see. So I'm consistent with Mark's view on this topic.
Thank you. And I think during your presentation too, there was a question about corporate debt pre-COVID versus some of the numbers you were talking about kind of post-COVID. Any comments on that?
Right, and so I saw that comment, and what strikes me is that prior to the crisis, the pandemic, there were a lot of concerns about the surge in corporate debt being an accelerant during this next downturn. And I think the real takeaway should be that those concerns were not validated. Is that market seems to be much more resilient than I think the more pessimistic takes that we saw on that going into this crisis. And I think that really speaks to a more resilient financial sector than we had, say, in 2006, 2007. One thing I have noticed is this intense desire to try to repackage this crisis into the terms of the last one. And this is a completely different crisis, episode. And so I don't think we can really, again, lean on some of those past examples to give us a lot of hints about what's going on before. And as Mark said, a big change here is just the amount of fiscal stimulus that came into the system that is really unprecedented for the kinds of downturn we had.
Thank you. It's a bit of a long question I'm going to read here. Regarding fiscal stimulus, how much of an impact will that have on the long-term economy? Are higher taxes or changes to government funding anticipated to cover the stimulus? And if so, will that have an impact on the economy over the next few years?
So if Mark wants to give an answer to this too, I'll let him. But I'll start out saying that I'm not worried about the fiscal deficit or the debt issued until we have some kind of inflationary issues. That would signal to me that they were actually pushing against the productive capacity of the economy. Right now, we haven't seen that. If at some point in the future we start to realize that maybe the fiscal actions have pushed us towards some kind of productive capacity, and we see that inflation, then we're going to have to rethink about really how should we address that via taxes or spending realignments. But I'm not terribly concerned about that in the near term. That's more of a longer term issue from my perspective.
Mark, any comments on that from your perspective?
No, agreed. I mean, people clearly, debt overhang is a concern over the medium and long term in terms of borrowing costs and the like. But right now, government borrowing costs are certainly not an issue right now. So people are less concerned about the debt, and plus it's also the right time in terms of the private economy being under capacity right now in order to take in the debt. the bigger concern would be what happened in the 7 or 8 years prior, when we got the debt. We had the debt rising while the economy was running at full capacity. That's something that would be more of a long-term concern if we continue to do that in good times and bad times. If we continue to run up debt, at some point it will come back to haunt us. And just one comment on the first question in terms of the business debt, the concern that, well, what about all these leverage loans, and that potentially was what was could have been going wrong with the economy before we had the COVID shock. I'm still a little sympathetic to that. Again, this longer time dynamic has yet to come true, and the reason we could kind of write off the concerns about this corporate debt was that as huge and unprecedented a level of corporate debt as we had out there, it was not out of line with business sales. Because business were selling so much and bringing up so much income. So as long as the debt was in line with the income, that's awesome. It doesn't matter how big the debt is, as long as the income can support it. Problem is, once we have this income shock and this recession, then it's possible that the income can drop overnight. That debt doesn't go away, right? And so then it becomes out of line. And so as we go forward, if we do see at this, a lower sales rate, if we start to see, businesses fail as we go forward, then some of this could come home to roost over time. I don't think there's been time yet for a lot of firms to default on their debt, even if they're starting to have sales problems.
Thank you. We had a comment here, or a question here, that they've seen different takes on whether we'll be in for high inflation or, I guess as Tim had said in March, possible deflation. What do you see now?
This is Tim's backyard. I'll let him hit this.
So yeah, I saw that question come up too, and I did talk about the possibility of deflation and back in March, and I was particularly concerned about that because of the extent of the negative demand shock we seem to be suffering. Now, in the last couple of months, we've seen those inflation numbers pick back up much more aggressively than I would have expected. And again, that came through in the Federal Reserve forecast as well. So I'm less worried about a deflationary shock or a persistent deflationary shock than I was, say, 3 months ago. And this is really consistent with the idea that this economy is really bouncing back more quickly than than we thought. Now, I'm still not worried about sort of a high inflation environment. And when I think high inflation, I think like a 70s or 80s type of environment. In order to get that, you really need a sustained link between inflation, price inflation, and wage inflation. And we haven't been able to make that link for decades. So I would be thinking that maybe at best you get inflation up around 2, maybe about 2, a little bit above 2% on how the Federal Reserve would measure it. And it would be hard to push beyond that without a real change in the dynamic of how we're dealing with the wage inflation, basically giving people wages to match higher inflation. So that's the in-between sort of ground I've been staking out. For me, that's important. I think maybe, and certainly in the heat of a crisis, you get caught up with the extremes, right? The extreme case of inflation or the extreme case of deflation. To me, just returning quickly to 2% inflation is fairly important in that it shows how quickly the economy can heal. Plus, the Federal Reserve has basically promised as much as they can to hold interest rates at zero for an extended amount of time. That means real rates adjusting for inflation are already predicted to be at -2% for an extended period of time, despite what we think of as pretty strong improvement in the economy. That sets the stage up again for very easy financial conditions going forward.
That's great, thank you. This one's for Mark, but I think it kind of builds on when you start talking about those kind of interest rates. Mark, do you see any indicators that Oregonians will be investing in capital projects, from the business community, or will we still see reticence and caution to hold back growth?
Yeah, right now I think it really depends on industry. I mean, in terms of business capital, one issue is a lot of our core employers, don't have the greatest business outlook right now. And, some of them, in terms of the aggregate capital spending that we see in Oregon, you add up, Intel, Nike, Boeing, and the associated metal makers and the like, and all of which have announced employment cutbacks and production cutbacks in recent weeks. That's gonna be an issue. Obviously, the airline being the biggest one, the Boeing stuff. There's probably not going to be a lot of investment there. And we look at other industries where Tim mentioned some of them that obviously may change given the nature of this recession. Every recession, there's a lot of churn, there's death and births of different industries, but there also usually accelerate some of these longer term structural changes in the economy. And here we probably will see acceleration going away from, bricks to clicks again. So your brick and mortar, retail, probably not a lot of investment there. Of course, your commercial real estate and your strip malls and office space, maybe not a lot of investment there. So there is some concern in terms of corporate investment. One maybe bright spot would be wood products. Wood products, the pricing environment is great, and if they could only get workers, they might be able to actually expand production for the first time in years and years and years. So that one's a positive, although boy, it's hard to predict in building a new mill, but it is possible. Another concern I have is with regular restaurants and bars and the like. Now, Tim is absolutely right that the demand for that's going to bounce back in a lot of the leisure and hospitality. And we saw this long-term trend going into the coronavirus with fewer and fewer meals at home, more and more meals eaten out, more and more served. And that's probably going to continue. So the demand is there, but I can't imagine the credit availability will be. Very much like coming out of the housing downturn when we had a shortage of housing, but all of the lenders and regulators were once bitten, twice shy if you had too much housing in your portfolio, or if, and the like. And so we didn't see the credit flow, even though all these housing projects would have penciled out. And I fear the same thing might happen with restaurants and bars. There's always a ton of churn with restaurants and bars, and good times and bad. They close, they open. This time, I don't know if we're going to see as many open, just given that I imagine lenders are going to be a little bit scared.
And one of our, as much as the wood products industry is an opportunity for us, because we do have some strong players in that already here in the region and in Marion County particularly. We also have a bunch of producers that like to have their products sold through restaurants and bars. So we've been paying particular attention to that part of retail just because we have so many food processors and beverage companies that depend on those markets. Our friends at Business Oregon, Amanda Welker, had some questions on whether there's any analysis or any information on export trade trends.
Mark, I don't know if you have anything. I'm not. My big concern on the export side is, or the international side, is to what extent have we entering into some kind of new trade war or Cold War with China, and how does that impact really, where we source supplies from? That seems to be the big question that could, again, be costly potentially for businesses as they sort of realign supply chains to a new geopolitical realities. But other than that, I'm not terribly thinking there's a huge amount of churn going on in trade relations right now, in our trading partners right now.
Yeah, and unfortunately, a lot of the trade export-import data is a little bit lagged. But what we are hearing, of course, is that log exports dried up entirely. But that's not the biggest factor in terms of the value of our exports. It's really dominated by the tech equipment. And although we haven't seen it yet, I would expect that to be very strong going forward. While Intel has issues about its business model, there's no question that there's a big surge in demand for all sorts of tech products, given all of the remote learning and remote work that's going on right now. And so I would assume with their within firm trade, we're going to see some pretty good export numbers going forward just to satisfy that demand.
Oh, thank you. And we're winding up here. We have one last question from Nick Williams. Are there any early economic indicators relative to Oregon's gross receipts tax on the overall economy? So I think that would be directed to you, Mark.
Yeah, like I mentioned briefly, we're still flying blind on the
Yeah.
commercial activity tax, because all we have now are two of these estimated payments. So we got in estimated payments, and they look to be about 80%, 83% of what we forecast, which, if accountants are doing their job right, because they only get penalized if they have this 20% cushion where they don't get penalized. And so if they're doing their jobs right, our forecast is online. But we don't know that, and I don't even think the accountants do until they sit down and actually fill out a tax return, which they won't do until April of next year at the earliest. We don't really have a good idea of what's going on with that. But we, like I say, the numbers are in line with our estimates, a couple $100 million every quarter, which is lower than what was originally forecast by the Legislative Revenue Office when the bill was passed. But of course, that was pre-COVID world.
Right. Okay, well, thank you very much. I think that rounds up our questions that we've got here in the queue. I'd like to thank Mark McMullen and Tim Duy for being with us today and joining us with your expertise. And obviously, this is a topic of interest to a lot of people, so we really appreciate your engagement and bringing your knowledge to the table. Also, thanks to the University of Oregon for the sponsorship of this event. And as Tim also mentioned, we hope to get back to doing these things in person before too long, and supporting our conference industry here locally. Would like to also just notify folks, we got word this morning and some good news at SEDCOR that we've got approved for a grant to look at increasing our footprint around ag innovation in the region. We've been doing some work in Polk County and the City of Independence the last couple of years, and we'll be now able to extend that to a 3-county region, and working with our partners at Oregon Entrepreneurs Network and Technology Association of Oregon, as well as some other local and some other national scale partners out of the Midwest. So more to come on that, but some exciting good news to share. And stay tuned for our next, we be planning for some similar events as we come up through the end of the year. So please stay tuned and watch your email. And once again, thank you to everybody for participating and logging on this afternoon. We appreciate your support, and be careful out there. It looks like you're in trouble when you're saying that, has or under 300 air quality is better, but it's better. And hopefully we'll be back to a little bit of blue sky by the weekend, with maybe a little bit of much needed rain to give us some relief as well. So be careful out there, and thank you all for your engagement and participation today.
Thanks for having me.